5 biggest mistakes people make, or maybe a few more, when buying a condo in Chicago. Number one, they buy in a building that's financially not stable. So they buy in a building where there could be a special assessment, which is basically just something that needs to be done to the building that's significant, like new windows, roof, tuck pointing concrete work, something that could cost a ton of money. And if the building doesn't have enough money in the bank, it could be a huge bill. Many times you have to pay in one lump sum. Sometimes they'll let you finance it. And if you're selling your place as a home seller, then you're going to have to pony up and pay, because 99% of the time the sellers will pay for this expense. Buyers have to look out for that, because sometimes they don't do their due diligence. They don't look at the meeting minutes from the condo meetings. They don't really evaluate the condition of the building along with the money they have in the bank, and they get caught holding the bag for it, because it doesn't need to be disclosed if it wasn't passed already. So that's number one. Number two, people sometimes think condos are far more affordable than a single family home, but they're really not. They're pretty darn expensive when you take into consideration taxes and the assessments. You can't you can't write off your assessments. So buildings with really high assessments, sometimes they're $800,000, $1,200, or sometimes they're $2,000 to $3,000 depending on the building. You know, that's a huge expense that you get no benefit from. And then the units are cheaper, but your monthly cost is what you need to focus on to make sure that it's affordable. And many times those buildings with high assessments get a pretty bad rap when they go to sell. People don't like them. Some buildings are pretty sensible and have amenities that really matter, like a doorman is an expensive one, but usually required for buildings that are large, at least having one to say 11 p.m. or midnight most days, and getting there by 7 a.m. in the morning. But some have 24-hour doorman, and with package deliveries and everything, it's kind of a big deal now. People really kind of expect that. But other amenities that are pretty costly are some of the perks, like, you know, hand car washes, car wash bays, big party rooms, pretty significant gyms where the equipment has to be replaced or has a big physical space, outdoor areas with grills, things like this. The assessments can go through the roof if people are, you know, paying for things they don't use a lot. And you know, this really needs to, you need to take a close look at these things, because they get kind of crazy. Some buildings in the suburbs in particular, where there's a lot of retired people that have moved down, they're used to having what they want and having their own space in single family homes, and sometimes they get a little out of control with what they vote to include in the assessment, and it really kind of goes bonkers. Another mistake that can be made in condo buildings is when you're applying for your loan, if you're getting a loan, 20% down puts you in a different category of, you know, going through underwriting. If you only put 10% down or less, the building has to be underwritten at a much higher level. So they will really take a close look at the building. So they're not only, you know, underwriting you and your qualifications, but they're taking a look at the actual building. And they do have lists of buildings that are not allowed to be lended in, and then other buildings they will lend in, but they're going to be looking at the minutes. Are there any lawsuits against the association? They're going to look at the condo policy, the insurance policy. They're going to look at a lot of things very closely, because they're not only investing in you, but the building too. So this can kill a deal, make a difference in rates, something to be really aware of. The rental policy, whether or not you're allowed to rent your unit in the building, is a big thing to consider. So it's a good thing if there's some flexibility, and lenders used to be more stringent upon the number of renters they would allow in a building, but they've gotten more relaxed with that. So you can typically get a loan in most buildings, even if there is a high percentage of renters. Just again, you want to look at the whole package and make sure the building's well kept, and look at the rules and regulations of what's allowed, how people live, noise regulations, quiet hours, things like this. and it's good to have some renters allowed. The ones that don't allow any renters are co-ops, which are a little different than condos. They're really strict and only owner occupied typically, and you got to be aware of that if that's the situation. You want to make sure that you're not buying in there if you do want to rent the place. But the investment side of a condo is usually not very good. In some peak markets, people have made good money, but a lot of times, they're really not a good thing to hold on to unless you're going to go long term, really long term, 10, 20 years, because, there's a lot of variables, special assessments, lawsuits, neighbor issues, tenant issues. Unless you're super committed, they're really not that great an investment typically. And a big one is be aware of the reputation of the building. There are some buildings that don't have a good rep. I've been selling for 30 years. I know the ups and downs on a lot of these buildings, reputation, what people like, what buildings are coming on the market that are going to compete with them. There's a lot of variables you got to be aware of. So there's a lot of just call, text, email if you need anything at all. Happy to help, any questions. And there's a lot of bad information, quite frankly, on YouTube from people making videos about condos, but they don't really sell a lot of them and haven't sold many of them for very long. So a lot of times they don't really know, a lot of the important factors as far as reputation and how the nooks and crannies here work.